Is all of the stuff that's going on in the stock market currently impactful enough to keep investors from even entering into the market? And that's what we're going to be discussing today. Should I wait to start investing until this market clears up? What's going on, everyone? My name is Trey, and welcome back to Let's Talk Finances, where you've reached the #1 channel that's going to be helping you reach your financial goals and invest your way into millionaire status. For those of you who are interested in one-on-one coaching to help you reach those target goals, I'll put a link in the description below to go to my website so that you can go ahead and schedule your one-on-one coaching session with me. So in this video, we're going to be going over 3 very particular sections to help bring brevity to those questions that you have. The first part is going to be what exactly is even happening in the market to bring about such uncertainty in investing. Number 2, we're going to be talking about timing the market and what impact that can potentially have on your investment goals. And lastly, we're going to be discussing, hey, what should I do here? What do I do? Do I not invest? Do I invest? What's the best way to go about it? So I'm going to be answering all these questions and going over all these particular subjects right now. Number 1, what exactly is happening in the market? First things first, we have inflation, all right? Inflation is basically the decline of your purchasing power of a particular currency. So in this particular event, the purchasing power of the dollar is declining. And what are some instances that's leading to this particular situation? Well, there's a number of them, but let's go over a few of them. Supply chain bottlenecks, higher demands, low inventory, labor shortages, and higher prices versus cost. But let's go into the second area of which is causing the market to do what it's currently doing, and that is rising interest rates. You see, the rise in interest rates causes massive price drops as well as sell-offs. And when this happens, individuals don't know if they should go into the market or put their money into something like a high-yield savings account. So the rise in interest rates takes the value away from those stocks that you and I will potentially invest in. And when this happens, it's when you see that your investments start to decline. When you see that the economy is very volatile, when you see that there are rumors of war, when you see that there's a pandemic like COVID, all of these things cause massive sell-offs. And when you have these sell-offs, the value of the particular company will start to decline. Although I could do a whole video on explaining this, if you even watch the news, you know there's a lot of craziness going on, all of which directly impacts the market. Which brings us now to our second section of this video, and that is timing the market versus time in the market. A lot of us who decide to invest in index funds do so because we understand what passive investing means. As a part of that, you also understand that timing the market is something that active investors do. Now, that isn't to say that active investing is good or it's bad. It's more of a strategy thing or a personality thing. But when you attempt to time the market, you're actually attempting to beat the stock market, which we all know that passive investors tend to match the market more than active investors beat the market. Here's something that's very important and crucial to remember when we're talking about investing. With investing, when you start is not as important as how long you stay invested. So the best way to build wealth is to stay invested, regardless of what the market is doing, although I understand that this may be a difficult thing to do. It's much easier to invest for long-term goals. Time in the market is much more important than timing the market. All right, so for those of you who are wondering, hey, the market is very volatile right now, should I even start investing? The answer is always going to be yes, so long as you don't have high interest debt, you have an emergency fund, and all of your X's and O's have been accounted for, then yes, definitely. But one thing that you should notate is that you should always refrain from investing money that you're going to need within the next 5 years. That's short-term goal investing. What we're talking about is long-term goal investing, and the differences being When you're investing for the short term, like buying a house or you need that money to pay tuition or whatever the case may be, you have a very short window. So let's say a 5-year window of which you may have something happen like what's going on in the market right now. It lasts for the next 3 years. Well, 2 years isn't enough for you to recover. However, when investing in longer periods of time, like 30 years, if you have an instance of which, you take a loss for 5 years, well, you have 25 years to rebound. So remember, when investing, it's always better to invest for long term. For us long term investors, these short term declines will not impact us at all. Which brings us into the third section of this video, which is what's probably most important to all of you. What should I do? Should I wait to start investing, or should I even pull out what I've already put into the market? Let's go ahead and tackle this. So one of the best ways to remain calm and continue investing during chaotic times in the stock market, like what we're currently witnessing, is to treat your contributions like subscriptions. And what I mean by that is incremental contributions, what we would call dollar cost averaging. Now, the opposite of dollar cost averaging would be lump sum investing. To give you a breakdown really quickly, dollar cost averaging would be the equivalent of you investing $100 a week, or $200 every 2 weeks, or $400 every month, whatever matches your particular situation. On the contrary, lump sum investing would be something more like, okay, at the beginning of the year, I'm going to go ahead and put in $6,000 so that I can max out my IRA, versus dollar cost averaging, where you hit that $6,000 mark throughout a 12-month period. Now, the next question might be, which is better or which is worse? Theoretically, you would believe that lump sum investing would be better because you have a larger amount of money in the market for a longer period of time. However, it may not always be the best method. Now, mind you, I'm not saying particularly that one is better than the other, but what we're talking about is being comfortable in investing during these volatile market times. And the best way to do so is by dollar cost averaging, all right? Because you're putting in smaller incremental amounts of money during these periods of time, it could bring you a lot more comfort in knowing, okay, I'm putting in $400 a month versus putting in $10,000 at one time, okay? Theoretically, lump sum investing is better over a long-term period for investing. However, dollar cost averaging currently still has its pluses. I personally do both. I do lump sum investing and I do dollar cost averaging. But to bring you a peace of mind during these times of volatile market activity, dollar cost averaging is the best way to bring you peace of mind and give you comfort so that it doesn't scare you away from investing. Simply put, if you're asking if now is the right time for you to start investing, well, the answer is going to be unequivocally yes. ... So long as you're planning to invest for the long term, and so long as you're investing smaller amounts of money incrementally over a longer period of time, aka dollar cost averaging, and lastly, so long as you're investing in highly diversified mutual funds or ETFs. So in short, is now the right time? Yes. Should you sell off what you've already invested to get out of the market until the market fully corrects itself? No, I don't believe so. Let's not forget that just a year and a half ago, we were in the same position where individuals were like, hey, the market is going to crash because of COVID. It's going to take about 5 years to recover. And what happened? We had some of the most highest highs during that period. You just simply can't time the market. Make smart investment decisions. Give yourself good strategies to follow for a long period of time, and everything will work out. There's always the comparison between a bullish market, which is when gains are on the high, the highest of the highs, and a bearish market where it seems like we're headed right now, where everyone are taking losses. Well, if you're an investor, you should actually be looking forward to those bearish market times. And the reason for that is when you're in a bear market, the price and or cost of these investments are going to significantly drop. So the best way to make this make sense is like Black Friday, when everyone decides, not I, but when everyone decides to go out shopping because they want to get, the 40% off deals or the 30% off deals or 80% off deals. It's essentially the same thing during a bear market. A bear market is the equivalent of a Black Friday sale. So in theory, instead of looking at it like, man, I'm taking so many losses, wait for the price of these stocks and shares to drop and buy tons of it. Now, when we talk about highly diversified mutual funds and ETFs, I personally always go to two particular ones to make as my core holding. And to give you a more extensive breakdown of it, just go down into the description and I'll put links to the particular breakdown of these mutual funds and ETFs. But that's going to be a total stock market index fund, which encompasses large cap funds, mid cap funds, and small cap funds. And also an S&P 500 index fund, which encompasses 500 of the largest companies within the United States. Just choose one or the other and go with it. I personally always choose a total stock market index fund. All right. So if you found any benefit to this video, please do not hesitate to smash the like button for the YouTube algorithm. And additionally, don't hesitate to subscribe for more videos similar to this one that's going to help you reach your financial goals much quicker. As always, I want to thank the men and women of this country who have served and continue to serve. My thoughts and prayers are with all of you. Thank you for your service. So until the next time, guys, let's talk finances then.